Ladies and gentlemen, good morning. Welcome to the National Bank of Serbia to another presentation of the inflation report for August 2012. Allow me to introduce the colleagues who produced the inflation report. On my left is Mr. Branko Hinić, General Manager of the Monetary Analysis and Statistics Department. Next is Mr. Branislav Zorya, General Manager of the Monetary Operations Department, then Ms. Snežana Vilaret, Head of the Macroeconomic Analysis Division, Mr. Mirko Đukić, Head of the Inflation Projection Division, and to my right is Ms. Marina Miletić, Head of the Inflation Report Division. I will now give the floor to Mr. Branko Hinić, and after his presentation we will open the floor for your questions. Thank you. Ladies and gentlemen, esteemed members of the press and fellow economists, the factors fueling inflationary pressures and at the same time dampening Serbia's economic growth include uncertainty in the euro area and overall weaker global growth prospects, increased expansiveness of our fiscal policy since the start of the year, high country risk premium and a downgrade of Serbia's credit rating, as well as unfavorable trends in global and domestic agricultural production. The main task ahead of the new government is the adoption of measures which would bring the medium-term budget deficit and public debt within the bounds envisaged by fiscal rules. The National Bank of Serbia expresses hope that the announced measures will be adopted to that effect and that the agreement with the International Monetary Fund will, as a result, be renewed. This would send a positive signal to investors and contribute to improved risk perception, stabilization of the foreign exchange market, and weakening of inflationary pressures. The factors that played a key role in the rise of the country risk premium and the build-up of depreciation pressures this year were increased government spending, suspension of the arrangement with the International Monetary Fund, and uncertainty in the euro area. And though the National Bank of Serbia's measures managed to appease the local foreign exchange market over the past several months, a more durable market stabilization remains contingent on the adoption of credible fiscal measures and implementation of structural reforms. Bad weather conditions prompted a downward revision of agricultural production for leading agricultural exporters since mid-June. Both worldwide and at home, this precipitated a rise in the prices of primary commodities such as wheat, corn and soy, and renewed the cost-push pressure on food prices. As anticipated in early editions of the inflation report, inflation has been rising since May. At 6.1% in July, it passed the upper bound of the target tolerance band. Inflation was driven mainly by heightened cost-push pressures on food prices and rising import prices. Unprocessed food prices recorded the strongest upturn over the past few months, with fruit and vegetable prices rising on the back of droughty weather and the low base effect, and fresh meat prices going up on account of rising prices of fodder. Further inflationary pressures, primarily on import product prices, came from the weakening of the dinar. Year-on-year inflation is expected to continue rising in the period ahead. After peaking in the first half of 2013, it is expected to settle within the bounds of the target tolerance band by the end of the year. Inflation growth will be fueled by several factors. Most notably, a surge in prices of primary agricultural commodities is expected to induce an increase in processed food prices. The high share of food in the consumer price index makes inflation highly sensitive to food price shocks, as shown by developments in the second half of 2010. Although the dinar may strengthen following the adoption of fiscal consolidation measures, past depreciation is likely to feed through to rising import product prices for some time yet. Growth in administered prices is also likely to pick up, as these prices were broadly flat in the year so far. Conversely, given rising unemployment and a modest outlook for economic growth, both at home and abroad, low aggregate demand will continue to dampen price growth.
Economic activity increased by 0.6% from the previous quarter, but fell by 0.6% from the same period last year. The quarterly increase resulted in part from the low base effect of the first quarter of the year due to the extremely cold month of February. Faster growth in exports relative to imports and rising government consumption and investment gave a positive boost to economic growth in the second quarter, while domestic private demand, both investment and household, subsided. Drought-induced contraction in agricultural output and deterioration of the growth prospects of the euro area led to downward revisions of Serbia's GDP growth forecasts from 0.5% to minus 0.5% for 2012 and from 3.0% to 2.5% for 2013. The prolonged drought is likely to significantly affect this year's crop yield, primarily of corn, our main agricultural product. Bearing in mind the share of agricultural output in gross domestic product and exports, this will bear down considerably on economic activity and trade in the coming period. In addition, the downgrading of the next year's growth forecasts for the euro area will reflect negatively on investment activity in Serbia and demand for our export products. On the other hand, exports will benefit from a production boost in the almost exclusively export-oriented automotive industry and from the past weakening of the dinar. A further rise in the unemployment rate, which reached 25.5% in April, and a meager increase in the household real income will continue to weigh on personal consumption and imports of consumer goods for some time yet. In a bid to ease mounting inflationary pressures, the National Bank of Serbia raised its key policy rate 3 times since June to the current level of 10.5%, while deciding at the same time to increase the portion of the required reserve allocations in dinars in order to withdraw dinar and free up foreign exchange liquidity of banks. The monetary policy stance in the coming period will depend largely on the character of fiscal policy. Providing that there is more efficient fiscal consolidation and structural reforms, including the continuation of the arrangement with the IMF, price and financial stability can be delivered at a lower degree of monetary policy restrictiveness. The future path of the key policy rate will also depend on movements in food prices and their impact on 1 year ahead inflation expectations. To a degree, risks are also associated with future developments in the international environment. High sensitivity of financial markets in the current situation to any disruption in macroeconomic and financial stability should also be borne in mind. In this context, the best way for the government and the central bank to contribute to the improvement of the business environment is to pursue a policy which ensures long-term macroeconomic stability. Such policy implies a sustainable level of public debt, medium-term price stability, and a stable and resilient financial system. Stimulating the economy in a manner which is not sustainable over the long run would jeopardize the achievement of the above objectives and result in deepening of the foreign trade deficit, a rise in the country risk premium and costs of borrowing, and deterioration of the business and investment environment. Allow us to highlight once again that medium-term sustainability is more important than the pace of short-term economic growth. Consistent with the above, we express our expectation that fiscal consolidation measures to be taken in the immediate future will bring the budget deficit and public debt over the medium run within the bounds envisaged by fiscal rules. On its part, the National Bank of Serbia will continue in the direction of stabilizing medium-term inflation at a low level and maintaining a sound financial system, which in our opinion is the best way to support the economy in the current circumstances. Thank you.
Thank you. We now open the floor for your questions. Please introduce yourselves before asking the questions. Novi Magazine. Do you have an estimation of inflation at the end of the year? Yes, we do have an estimate. Of course, it is presented in our inflation report in the part relating to the inflation projection. I will ask my colleague to answer this question. There are certain risks that occur depending on the scenario that may be expected regarding primarily movements regarding regulated prices and changes in the VAT rate. I will now ask my colleague in charge of macroeconomic projections to give us a broad overview of risks and expectations. As Mr. Hinic said, and as you could see in our presentation, according to our central projection, of course, we expect the central projection is based on certain assumptions regarding regulated prices and their increase in this year, according to the central projection, which does not have to materialize, but as I said, according to the central projection, we expect regulated prices to increase from 9 to 5%. What is noticeable and what has already happened and what is consistent with our expectations is that the increase in regulated prices in the first 7 months was practically non-existent. It was very low, only 3.1%. What we expect to see and assume to see until the end of the year is that electricity prices will go up, that gas prices will increase, and that medication prices will go up. If this happens, then regulated prices for the entire year should increase by 9 to 9.5% for the entire year. We produce this fan chart consistent with this, and this fan chart presents our projection, as you can see in this chart. Mirjana Brajković, RTS. Could you explain these projections? Did they include a calculation of VAT increase, and what is the real estimate given the droughty weather and an absence of government measures to support agriculture? Can we expect a 15% inflation in September already? We included the effect of a VAT increase in the central projection. We included expectation of an increase in VAT rate from 18 to 20% and from 8 to 10%. So this is a risk. If these corrections do not happen, inflation will be lower. As regards prices of agricultural products, they have already displayed a trend of growth. We cannot expect a major change in agricultural policy and its effect on prices of primary agricultural commodities and food prices in this current year. This is a long-term process and a long-term activity which should ensure that these 2-year cycles of food price increases would be absent in the future, that we would have a stability in the market of primary agricultural commodities, and a stable foundation for agricultural production. What we expect over the short run is the use of Republic commodity reserves, in the sense that they should be the basis of intervention in the event of low supply of agricultural products, or in case of increased supply of agricultural products in the event of purchase of agricultural products. So this is what the government could do, and it could invest funds that would contribute to stabilization and produce a positive financial effect from the viewpoint of the budget. As in the case of large supply, it would buy at somewhat lower prices, and in the event of lower demand, it would place at higher prices. Of course, there are other short-term measures that would have some less favorable results, such as intervention imports, which would have adverse effects from the aspect of foreign trade. Measures are possible that will go in the direction of limiting exports, but these are measures that cannot produce durable and viable effects on the stabilization of the market of agricultural products. As regards headline inflation until the end of the year, the upper bound is which? The upper bound, you're talking about the upper bound of inflation until the end of this year, but this is associated with the risk of some special risk that would push inflation upwards. What we're talking about is that even the central projection, which includes VAT increase, adjustment in regulated prices, which are not announced until the end of the year, but we have included them in the projection. So there are certain risks that inflation will be below the central projection. Around 9%. Between 9 and 10% for the end of the year, but as we again say, this is a central projection. There are both upward and downward risks, upside and downside risks, and we gave our expectations regarding regulated prices. Whether this will happen or not, this does not depend on us. It is a great risk, but it can help us to fall below the central projection. As regards prices in food prices, it is important to note that the monetary policy does not, as a rule, respond to such shocks, as it is impossible to achieve certain positive results by adjusting monetary policy measures in this segment. Our response is actually aims to prevent the transfer from the increase in these prices to inflation expectations and to an increase in other prices. So this is the second round of the effects. If I can add, in the inflation report, there is a text box where we treated the impact of a poor agricultural season on GDP and inflation, so you can see you have details in that text box. I would also like to add another question. That a lot depends on what fiscal policy does, whether and when it will take measures, and what these measures would look like if no measures are taken. What can we expect as regards the exchange rate? This is what citizens first notice: prices and the exchange rate. As regards the economic theory, it is perfectly clear. Any increase in aggregate demand puts certain pressure that can reflect in several directions. One of these directions is domestic production, in terms of an increase in domestic production. The second is an increase in export supply, which then has a negative impact on the foreign trade balance, on the current account balance, and indirectly it reflects on the foreign exchange market, placing pressures on the exchange rate. The third impact is the one that will go in the direction of an increase in prices. Of course, the question of specific measures that will be taken within fiscal consolidation is still open, whether it will go on the income or the expenditure side. In terms of achieving long-term price stability, it is We would expect fiscal consolidation to be taken on the expenditure side, and we hope there will be cuts in spending. Certain positive effects would also come from an increase in VAT, as this would put increased pressure on imports. It will work in the direction of reducing imports. On the other hand, it is very important in which direction the change in the composition of expenditures would go. What is more important for us is that, for instance, there is no cut in expenditures at the expense of capital expenditures, as this limits certain other activities of the state in a certain period, such as infrastructural development, etc. So it is a general assumption for assuming new investments and starting new production.
Thank you. Any further questions? We have enough time. So there are many unknowns here. But if, for instance, prices of administered prices are frozen, what would be headline inflation in that case? By the end of the year, we will have an effect of -1 percentage point relative to the central projection. If we do not have a rise in electricity, gas and medicaments prices, our central projection would be lower by 0.1 percentage point. So the end of the year itself is not important. What is important is the existence of inflationary pressures, whether the prices of electricity will be adjusted in November, January, February, all that is important for us as consumers. But whether there will be a certain pressure in terms of price hikes in that respect, it's something that is unknown, that is ahead of us. Yes, any further questions? Gordana Filipovic from Bloomberg. So at the end of the year, current account deficit, the FDI projection for the end of the year, and what would be the amount of current account deficit. In terms of the current account deficit, we expect the current account deficit to reach around 2.1 billion euros. So we adjusted the current account deficit. So the reason for the adjustment, for the revision, is that we will have a bit more unfavorable movements in foreign trade, but also this will be almost around 11% of GDP, that is 10.7%. And what is also evident is that we expect that a large part of the deficit, you already know that, took place in the first half of the year. We already have around 1.9 billion euros in the first 6 months of the year. So in the second half of the year, the current account deficit will be around 1.2 billion euros, which is a reduction. The reasons for the reduction is the launching of some important businesses in terms of exports and the absence of some extraordinary circumstances that were typical for February. So the reduction would be relatively significant in terms of the first half of the year. The share of the current account deficit in GDP will be around 14%, and in the second half of the year, it will be around 8% of GDP. And what is the reasoning behind this? So the very important assumption is that we expect a lower foreign trade deficit in the second half of the year of below 400 million euros per month, and it will be increased by expenditure in respect of interest interest repayments of around 100 million euros per month, and this will be covered by relatively significant net inflows originating from current transfers of around 250 million euros per month. And essentially, we would have, together with other items that would have some positive effects, so we would be able to ensure the financing of around 200 million euros per month on average. This will be made possible partly through FDIs. So you know that currently FDIs are in a minus, but this minus is a result of the outflows coming from two businesses that were relatively important and that are behind us. So right now we have an increase of FDI inflow in July, for instance, and we expect that until the end of the year we will have a net inflow from FDIs of around 550 million euros. That is 420 million euros for the whole year. So it will be, to be precise, it would be 560 million euros. So this is ahead of us. So it seems to be relatively high, but we should take into account the fact that we didn't have such a poor inflow of FDIs, but outflows were actually very high in the first half of the year. Thank you. Do you have any further questions? If not, I would like to thank you all and see you in November at the next presentation of the inflation report. Thank you very much.